Hello and welcome back to Money Gist Top 5. I'm Misi Dada. The Central Bank of Nigeria's Monetary Policy Committee has concluded its November meeting, opting to maintain key policy rates as it monitors inflationary pressures and financial stability. The committee retained the monetary policy rate at 27%, the cash reserve ratio at 45% for commercial banks and 16% for merchant banks, while also keeping the 75% CRR on non-TSA public sector deposits unchanged. The liquidity ratio remains at 30%. The MPC, however, made a technical adjustment to the standing facilities corridor, now set at plus 50 minus 450 basis points around the MPR. This adjustment gives banks more flexibility in borrowing or depositing funds with the CBN while keeping the benchmark interest rate intact. The MPC stated that maintaining these parameters reflects its cautious approach to taming inflation while supporting ongoing economic recovery.
In inflation across the three measures, headline, core, and food, in October 2025 suggests that the lagged impact of previous tight policy measures is expected to continue in the near term. Thus, maintaining the current stance of policy amidst lingering global uncertainties would allow the effects of previous policy rate hikes to sufficiently transmit to the real economy and further reduce prices.
By holding the MPR and CRR steady, the CBN signals a continuation of its tight monetary stance, prioritizing price stability in the face of persistent inflationary pressures. The adjustment of the standing facilities corridor provides commercial banks with greater operational flexibility, potentially easing short-term liquidity challenges without altering the overall monetary policy stance. Market watchers are likely to interpret this as the CBN balancing inflation control with financial system stability. The Central Bank of Nigeria is proposing tougher penalties for anyone who repeatedly issues DAT checks. Under a new exposure draft released on Monday, repeat offenders could face an automatic 5-year ban, and that ban will renew every time the person reoffends. The draft guideline, titled Guidelines on the Treatment of DAT Checks, aims to restore trust in check transactions and strengthen financial discipline across the system. It replaces all previous circulars on DAT checks. Under the new rules, once a check bounces due to insufficient funds, the bank must report the incident within 1 hour to the Credit Risk Management System (CRMS) and at least 2 credit bureaus. The customer must also be notified within 2 working days with full details of the dishonored check. Banks are required to keep a copy of every DAT check for at least 5 years and must warn customers about the consequences before issuing checkbooks. A customer becomes classified as a serial DAT check issuer after issuing 3 DAT checks across the banking system. Once flagged, the CRMS will alert all banks and financial institutions, triggering restrictions. This includes a 5-year ban from the clearing system, opening current accounts, or accessing credit of any kind. But the strictest part of the guideline targets repeat offenders. If a person after serving the ban issues another DAT check, they will automatically receive another 5-year ban with no upper limit. This means persistent offenders can be locked out of the financial system for very long periods. Banks that fail to follow the rules also face stiff penalties. Infractions such as failure to report incidents, failure to notify customers, or reopening accounts without proper checks attract fines ranging from 1 million to 5 million naira. Credit bureaus can also be fined up to 2 million naira for incomplete or inaccurate records. The exposure draft is open for public comment for 3 weeks and is available on the CBN website. Feedback should be sent to the Director of Financial Policy and Regulation. According to the CBN, the revised guideline is designed to deter abuse, protect the payment system, and enforce better compliance across the industry. Nigeria's capital market is set for a major upgrade. The Securities and Exchange Commission has approved the transition from the current T+3 settlement cycle to a T+2 cycle, and this kicks in on Friday, November 28. What does this mean? It simply means that when you buy or sell shares, the cash and the securities will now be fully settled within 2 business days instead of the current 3 business days. This shift puts Nigeria in line with global standards, boosts market efficiency, and reduces the risks that come with delayed settlement. For investors, this is good news. You get your cash or your shares one full day earlier, and you are exposed to fewer price fluctuations before settlement. It also frees up capital faster, which supports liquidity and allows quicker reinvestment. Overall, the T+2 cycle is expected to make Nigeria's capital market more competitive, more attractive to global investors, and more resilient. Nigeria is expecting nearly 200 million litres of petrol to arrive through various ports this week. This comes as several vessels offloaded a combined 149,500 metric tons of premium motor spirit across Tinkan, Calabar and Warri ports. Why is this news? Just days ago, the federal government postponed its planned 15% ad valorem import duty on petrol and diesel. That tax was supposed to start immediately after President Bola Tinubu approved it in October. The idea behind the duty was to protect local refineries and keep the downstream market stable, but it would also have made imported fuel more expensive. With the suspension, importers have rushed back into the market, and that's why we are seeing the surge in fuel shipments. According to the latest shipping position from the Nigerian Ports Authority, Tinkan Island handled the highest volume, with 58,500 metric tons arriving within 2 days. Calabar Port received 46,000 metric tons, with more expected through Dozie Oil and Northwest Petroleum. And Warri took in 45,000 metric tons through Ren Oil and Matric Energy. Meanwhile, fuel marketers are rethinking their strategies. This is because the Dangote refinery recently cut its ex-depot petrol price by 49 naira per litre, making locally refined fuel suddenly more competitive. Marketers say this price drop has changed the entire supply dynamic, and the postponed import tariff only adds more uncertainty. So, in summary, a temporary tax suspension has triggered a short-term spike in petrol imports. Dangote's price cut is reshaping the downstream market, and the battle between imported and locally refined fuel is heating up again. At a seminar for the Finance Correspondents Association of Nigeria, FICAN, in Lagos, the Central Bank of Nigeria has given new insight into how it plans to help build a more stable financial system. Dr. Afangide Johnson from the CBN's Monetary Policy Department explained to participants that Nigeria's monetary and fiscal policies must work together. According to him, when they don't align, the economy ends up suffering from rising inflation, unstable exchange rates, and uncertainty for investors. Also speaking, Chief Economic Strategist at the ECOWAS Commission, Professor Ken Ife, said Nigeria's economic managers are now taking steps to reset the country's direction. He noted that there is a new coordinated framework focused on restoring price stability, lowering inflation, strengthening the financial system, and improving debt management. Professor Ife pointed out that Nigeria has previously battled challenges such as fiscal dominance, excessive borrowing from the CBN, and inconsistent policy actions, factors that weaken the bank's ability to stabilize prices and protect the naira. He explained that the new push places strong emphasis on allowing the CBN operate independently and return to its core mandate, keeping prices stable and ensuring a resilient financial system. Going forward, decisions like adjusting the monetary policy rate will be based strictly on data and free from political interference, similar to what happens in advanced economies like the United States. Professor Ife highlighted improvements in Nigeria's foreign exchange position. This includes NNPC's decision to route its revenues through the CBN, higher crude oil production, and an increase in refined product exports from the Dangote refinery. All these are expected to support a more stable exchange rate. Finally, he noted that the new Forex code recently introduced by the CBN is designed to boost transparency in the FX market, strengthen the managed float system, and attract more inflows from foreign investors, diaspora remittances, and exporters. So what's your take on any of the Money Gist top 5 stories for today? Make your thoughts count in the comment section. Like and subscribe for weekly updates on Nigerian economy and money moves. I'm William Isidada. Thanks for watching and see you in the next video.